Hello and welcome to The Explainer. You ever stare at a stock chart and just see a chaotic, jagged mess of lines? It feels random, right? Well, today we're going to talk about a secret language, a way to find a hidden message in all that noise.
I mean, that's the big question, isn't it? Is this all just unpredictable chaos, or is there something more to it? Is there a pattern, a grammar even, that you could learn to read if you just knew what to look for?
Well, believe it or not, over a century ago, one guy looked at that exact same chaos and said, "Nope, it's not random at all." He saw a story with a beginning, a middle, and an end. And that man was Charles H. Dow. Yeah, the founder of the Wall Street Journal. His big idea was brilliant in its simplicity. He said the market isn't a random mess. It moves just like the ocean. It has these powerful underlying tides, secondary waves, and tiny little ripples. And if you can just figure out which way the main tide is flowing, you're already ahead of the game.
Now, I know what you're probably thinking. 100-year-old theory? In today's world of supercomputers and instant information? Come on. But here's the thing. This isn't just some old theory. It's literally the foundation of almost all modern technical analysis. It's the original rulebook.
So, how do we start reading this market language? Well, it all starts with Dow's big idea that not all market movements are created equal. You have to understand the three different tides that are always at play. Let's stick with that ocean analogy because it's perfect. First, you've got the primary trend. That's the main tide. It's the big, long-term direction of the market lasting for a year, maybe even several years. This is the one that really matters. Then you have the intermediate trend. Think of these as the waves. They're corrections that move against the main tide and can last for a few weeks or a few months. And finally, you have the minor trend, the little ripples on the surface. That's the day-to-day noise. The whole secret is to not get distracted by the ripples and waves, but to always know the direction of the main tide.
And spotting that tide, it's actually way simpler than you'd think. An uptrend, what we call a bull market, is just a series of peaks and valleys, where each new peak is higher than the last one, and each new valley is also higher than the last one. Higher highs and higher lows. That's it. A downtrend, or a bear market, is just the opposite. Lower peaks and lower valleys. Once you see this, you can't unsee it. You're not looking at random noise anymore. You're actually starting to read.
But here's where it gets really interesting. Dow didn't just stop there. He laid out a whole system with 6 core rules that govern how everything works. These are kind of like the non-negotiable laws of market physics, according to him.
And these 6 rules create a complete framework. The first one is huge. The market discounts everything. That means any news you hear, good or bad, is already baked into the price. We've already talked about number 2, the 3 trends. The others build on that, saying that big trends have 3 distinct phases, that major market indices have to agree with each other, and that trading volume should increase in the direction of the trend. And the last one is absolutely crucial. A trend will keep going until there is a definite, clear signal that it has reversed.
Okay, let's zoom in on that idea of phases, because this is where the psychology comes in. According to Dow, every major trend follows a predictable storyline. It's got a beginning, a middle, and an end. And if you know which chapter you're in, you have a much better idea of what's coming next. So take a bull market. It starts with the accumulation phase. This is when the smartest investors, the smart money, start buying things up when nobody else wants them, when all the news is terrible. Then comes phase 2, public participation. Now, the trend is obvious. Business news is good, and the general public starts to get excited and jump on board. This is what really pushes prices up. And finally, you get the distribution phase. The hype is off the charts, there's euphoria everywhere, and that same smart money that bought in phase 1 starts quietly selling to the excited masses. Which, of course, brings us to the million-dollar question for any investor. If a trend keeps going until it stops, how in the world do you know when it's about to stop? How do you spot the moment the tide is finally about to turn? Well, Dow theory gives us some really simple visual clues to watch for. One of the most famous is the double top. It looks just like the letter M. The market hits a new high, pulls back a bit, and then tries to rally again, but it fails to break that previous high. That's a huge warning sign that the buyers are running out of steam. The opposite is the double bottom, which looks like a W. It suggests the sellers are exhausted and the tide might be ready to come back in.
So we've seen the logic, we've seen the rules, the patterns, the whole shebang, but we have to tackle the elephant in the room. In a world of AI, algorithms, and high-frequency trading, does a theory from the horse and buggy era actually still hold up?
And the real answer is, it's complicated. The huge strength of Dow theory is its focus on the big picture. It helps you zoom out and understand the overall market direction and, more importantly, the mass psychology driving it. But, and this is a big but, it's not a crystal ball. It can be slow to give you a signal, meaning you might miss the exact top or bottom. And it's definitely not a precise tool for timing your entries and exits down to the penny. In the end, Dow theory isn't some magic system that's going to make you rich overnight. It's a mental model. It's a framework for thinking about the market's natural rhythm. Because while technology has changed beyond recognition, the two things that drive markets, fear and greed, haven't changed at all. So the real question is, can this century-old wisdom, based on something as timeless as the ocean, still give you an edge? Can it be a compass in our wild, modern financial world? Well, that's for you to decide. Thanks for joining us.